Vinit, your investment framework is very well documented. At the very outset, I'd like you to throw light on the investment case for your style of investing. Where do you think does your style fit in an investor's portfolio?
Yeah, I think this is most relevant question, Ankita, and it actually takes me back to when I really started managing money for investors, and the principle, and this was in the year 2010. We had come out of the Lehman crisis. We had seen the 2008 fall, and before that I had seen the 2000 fall as well, the dot-com boom and bust. When I got into managing investors money, one principle which I had in mind was how can we do a good job of really managing the hard-earned investors money well, which means that when we are investing into companies, we would like to sort of look at creating long-term wealth for the investors. And the other principle was that we would really like to eliminate companies, businesses, or managements where we have less comfort on, which actually reduces the chances of committing errors. So basically, it was a principle which was based on selection of good quality businesses and elimination of poor quality. So it was as much as selection as elimination, frankly. So I think that is the most important aspect. Now, where does this actually suit? I think it generally is well suited for all types of investors, just that many investors are they need to be educated that investment is really a long-term business, and it's not to derive returns in the short cycle. So those also are part and parcel of this journey, but most investors tend to get excited by the short-term return profile, and they miss the long-term big picture, which is really about what we call it a wealth creation. So from that perspective, I think it is very important to sort of have a framework which allows us to work in this fashion, and this is something which we have been following since the beginning. Just that we documented it 3 years back for our investors to understand our principles and philosophy well. We believe that if we keep following this framework of identifying good companies and eliminating bad companies over a period of time, this should work well, and it should achieve the objective of that long-term wealth creation, which most investors really want to achieve. Is my thought. The other aspect is that when we say long-term, we actually truly believe in that approach, and that is also seen from our portfolio actions itself, wherein when we try to buy companies, we are really trying to buy businesses. We hold them for long. Our churn ratios are probably the lowest in the industry. Why we hold them for long? As I said, we believe that businesses take time to flourish, prosper, grow, and create wealth. And that is what we have sort of differentiated ourselves in terms of showcasing a lot of patience, both while going through good times, bad times. We also go through bad times, because there are times when markets are in a raging bull phase, and our set of businesses, companies are not performing. So I think we've gone through all of that, but we very confidently believe that this approach of identifying good companies, and probably as we go ahead, I will explain what exactly goes into the definition of these good companies. But that's what I believe should eventually lead to achieving the objectives of the long-term investors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.